Good morning and welcome to this month's, so April's Newswire Bulletin. Been a fairly quiet month of April. Obviously we've had two, depending on where you are with schools, possibly 3 weeks off. Parliamentarians have backed off as well. So pretty quiet month all in all. A couple of cases through the tribunal system that are of interest. So if you're interested in keeping up to date with recent case law, please have a log on to our Spring Tax Update course, which is picking up recent developments. Other than that, the Finance Bill has started its general process through the House of Commons, so it's quite at the early stages at the moment. If you're interested in Finance Bill particularly, we'll be running lots of Finance Bill courses in May and June, so please feel free to log on to one of those. You'll also see in the Newswire Bulletin a little reference to, I suppose, a continuing theme. We've had announcements picked up in some of the earlier months regarding a bit of a deferral to the £100 late filing penalty, so an extra month's grace to late paying as well, but of course both of those have now expired. What the Revenue have now done, and you'll see a bit more information in the link in the body of the Newswire, they've introduced a bulk filing for agents, so en masse filing of appeals, which is a bit of an unfortunate position to be in if you're going to have to bulk file for clients because clients didn't meet those extended deadlines. But if that's the case, bulk filing, so rather than appeal each client one by one, you can add a list and say, these are all my naughty clients, my excuse is coronavirus, and away you go. So an interesting development from the Revenue for this particular tax return profile. The second item that you'll see referred to in the body of the Newswire email is a Finance Bill development. The Revenue have issued a bit of a guidance on it. Interestingly, the legislation is still to pass, and yet the Revenue are saying, you can go ahead and claim it. But one of the interesting repercussions of that is that because the law is not already there, what they're saying is businesses will have to claim essentially a repayment come the end of this tax year for the first year of this, but for the next 2 years, essentially, you will not have to operate it from the start of 22-23 and 23-24, which I suspect is because the legislation isn't actually in place. Of course, I've told you all of that, and I haven't told you what the actual issue is. So this is a national insurance holiday. Some of you will remember we've had national insurance holidays in the past, and they are essentially a relief from employers' NI up to the upper earnings limit. So the government have introduced another one of those specifically. There has been some talk about a more general national insurance holiday to encourage businesses to take on staff. I think the problem with that at the moment in terms of our economic situation is at the moment we're still in the mode of not losing your job in the first place, as opposed to encouraging employers as their businesses grow to take on staff and giving them an incentive to do so. So it may well be that you see further versions of NI holidays. We've seen them in the past, but I suspect not yet, because we're just not in that sort of economic position at the moment. This particular national insurance holiday is very specific. It is aimed at former military veterans. So if you served 1 day military service, which would seem a bit odd, presumably you did something naughty on day 2, but if you served 1 day of military service and an employer takes you on, then the employer gets relief on earnings up to the upper earnings limit from any employer's NI. So there's no relief for the individual, but a sort of national insurance break for the employer. As I was saying, for the first year, for the current tax year 21-2, that will be something which is going to have to be claimed in arrears. So the Revenue's guidance says at the moment, and you'll see that laid out via the link. Quite an interesting transitional point on this, in that if the military veteran started, let's say, 1st of October last year, then on the balance of their first year of service, i.e. 6 months into 21-22, the employer can ultimately claim relief for that. So it's not about employees necessarily you take on post 6th of April this year. Obviously that will entitle you to potentially full relief, but it's for periods falling in essentially 21-2, 22-3, 23-4, so it's a 3-year deal at the moment. It's the first year of service, or the bits of that first year of service which fall within that 3-year spread. So again, quite interesting if you've got any clients in that situation. I've had one or two questions about that. Mechanically, just a bit of a pain because you're going to have to pay it first and wait to recover it in due course, which takes away a bit of the incentive for the employer, you would imagine, for this particular tax year. But that's the national insurance holiday for employers, and obviously our finance bill course will delve into that and lots of other things which are part of this year's finance bill process. The final snippets of our Newswire for this month relate to self-employed income support. So we've got a little blog there with some general information for you to talk to your clients, and then we've got another one more specifically for yourselves relating to the tax return process. So we've had the legislation passed on both self-employed income support and furlough. Now, furlough is pretty similar to what we've had before in many respects. Self-employed income support, there are some nuances within that, and the first one, I suppose, is that you are now basing the primary test on income, on the profits test 50,000, that being more than half your overall income. That test initially being based on the 1920 return profile, because obviously the revenue, hopefully, unless you're bulk appealing for late filing, hopefully most clients have got that in now. So the primary test revolves around 1920. There are some changes because of that, because you've updated the profile for a year essentially. The client will have to have traded in 1920 and 2021 and say that they intend to continue to trade in 21 too. All relevant returns, which I'll come back to in a moment, will need to have been submitted to the revenue prior to budget day. So it'll be returns prior to budget day the revenue are basing this on. And of course your business has been adversely affected by coronavirus. And this is covering the period 1st of February to, the law quite interestingly said originally, the 31st of April. So it is a strange year. But for that 3-month spread, that's what we are looking to make the relevant commitments in respect of. As I said, the 50,000 test, that being more than, self-employed income being more than overall half your overall income, that test is pretty much the same. Judge it for 1920 in isolation, but then if you're a long-standing business, so you've traded for donkey's years, if you don't meet it for 1920, you'll now look at a 4-year spread, 16-17 to 1920. If you started trading 17-18, you'll only look at 17-18 to 1920 and so on and so forth. So that element of the test is pretty similar, I would suggest. Interestingly, the further on you get within self-employed income support, interestingly, the third and fourth variants of income support are quite different to the first couple, more stringent. And I will read this in a moment just so I get it right, but you have got to make a commitment as part of this for the period February to April. That, and I will read this, that being referred to as the qualifying period, but the business has suffered reduced activity, capacity or demand in that period, in that 3-month period, from that which could have reasonably been expected in normal times because of the impact of coronavirus, and then an additional test in relation to the basis period in which that 3-month period falls, or basis periods possibly. The business would expect a significant reduction in trading profits. Now, depending on your year end, of course, you may be a long way away. I mean, if you're on a December year end, how do you know for December 21 that actually you're going to suffer a significant reduction in trading profits overall when actually you may already have reopened to the public? So it's a quite interesting, guesstimate that's being required up front, and that has been a feature of the third and fourth variants of this, but not the first and second. The other thing which is a bit different is the revenue are saying that obviously they will base all these figures on returns that were in their system for the relevant years, whether it be 16, 17, 17, 18, whatever, as at budget day, as at sort of end of 2nd of March. But if there are amendments to any of those returns, particularly 18, 19, 19, 20, then what they're saying in that regard is that if those amendments increase your entitlement, they'll be ignored. But if they reduce your entitlement, the revenue will want the money back. So again, there's a nuance within this as well that hasn't been there before. And I think that kind of leads me on to the next point, which is what the blog for yourselves is about. which is completion of the tax return. I think the first interesting question that comes from all of this, so much of SEISS has been directly between the client and the revenue, and each one is slightly different. There have been various commitments that have been required to be made by the client. When you get to tax return process for 2021, to what extent are you going to scrutinise the first 3 claims, or are you just going to take a view of saying, well, actually, you, Mr. and Mrs. Client, did this, you will need to keep evidence that you met the tests in a draw probably for at least 6 years, and actually don't scrutinise it and leave it as the onus on the client and the revenue with wherever that leads in due course, because clearly there's going to be some compliance in this area. So I think there's an interesting sort of question that arises from your perspectives. The secondary element, when you start to look at the new return process, and there's an element of this that feeds into corporation tax as well, but obviously corporation tax is not inclusive of SEISS. What the return is requiring you to do is essentially isolate turnover in one box, coronavirus support payments, whether they be furlough or sick pay rebates or local authority grants, whatever it may be, in a second box, and then in a third box isolate SEIS payments. Now, that's quite interesting, and the taxation treatment, again, self-employed income support is taxable on a receipts basis. So if your client has claimed all of these, you are expecting to tax in 2021 the first 3, irrelevant of the accounting treatment of those items. Now, the other items, I suppose generally in terms of government grants, you have probably been recognising those on an accruals basis. So it's quite interesting in terms of the guidance notes. For the other job support payments, they seem to be saying, if you recognise those in your accounts, can you isolate turnover from accrued amounts of furlough or whatever it may be? But then SEIS may be a different figure to what you've recognised in the accounts, again, because that's on a receipts basis, and you've got 3 different returns boxes there, so that will be a bit of fun to keep on top of. The other thing you'll see is a box towards the bottom of the return in sort of the tax due area rather than income, to say if you are not entitled to, let's say, self-employed income support, this is the box you put it in at this stage to give it back to us. So that's, you're now starting to see, and one would imagine all those boxes are to do ultimately with a compliance process. It was announced in the budget there'll be a lot of money thrown at compliance in this area in the future, and I think that's probably a fair comment from the government that so much money has been devoted to supporting businesses. It is probably fair in the fullness of time if the revenue write to any client who's had anything and say, please could you just clarify that you were entitled to this at the time. And I think that will be an interesting part of your jobs over the next this return process, next return process, to say, actually, Mr. and Mrs. Client, you did your furlough claim, but you must keep that information and keep it in a drawer. We're not going to scrutinise what you did unless you pay us. But fundamentally, you've got to keep that because the revenue will have 4, 5, 6 years to come and knock on your door. So that's what the blogs are about this time. If you're interested in SEIS, we've got client support letters, we've got various webinars in relation to the various support schemes that have gone on. So good luck on all of that, rather you than me, and more fun and games for the next lot of returns. And no doubt you'll be trying to sort that out on the 30th of January next year. So good luck on that, and I'll see you again soon.
Thanks very much for that, Mark. Now it's over to the Audit and Accounting segment with me, Jeremy Williams. And here we are at the end of April. Spring's definitely set in, hasn't it? We've had weeks of glorious sunshine. And I'm pleased to announce we've got quite a few topics to go through for A&A this month. And we're starting with perhaps the most important one in terms of the amount of queries it's generating. And that is reporting on irregularities in the auditor's report and new guidance from ICAEW on exactly what to say. Now, this is a hot topic. We're repeatedly asked questions both on Mercia Live courses and through our technical inquiries service, our TQs service as we call it. Lots of auditors are wondering what exactly should they be saying in this part of the audit report. And in case you're not familiar with this, let's just give you some background. This is a requirement in ISO 700 and it's part of the FRC specific guidance around this in their compendium, that in the Statement of Auditor's Responsibilities, which is towards the back of the audit report, the auditor explains what we mean by an irregularity, including fraud. These are instances of non-compliance with laws and regulations, or NOCLAR, as we're now calling these. Or is it NOCLAR? I'm going to say NOCLAR. And the auditor has to talk about how we address the issue of responding to the risks of NOCLAR. And here's where the FRC expects you to explain to what extent you think your audit is capable of detecting irregularities. And then they leave it open to the auditor to include text, which they don't want to be boilerplate text. Indeed, the feedback consultation suggested in the cost-benefit analysis that managers would be spending an hour per audit, in their estimation, on coming up with wording for this part of the audit report. Now, whether you think you'll be spending an hour on this or not is up to you, but certainly it's not meant to be just a standard paragraph or series of paragraphs that you copy and paste into the audit without thinking about it. So what do we actually say then? Well, there's been increasing confusion about how long this should be, particularly for SME type audits. It's been the case now for some time that in listed audits we've seen text on this. In fact, some of us have been showing the Grant Thornton report on our parent company, Wilmington PLC, and we've included the text that they've used just as an example. We're not suggesting that or recommending it, but as an example of the kind of thing that auditors have been doing. But how long should it be for an SME type audit report? Well, what we've got in the Newswire is new guidance from ICAW, which is for auditors reporting for the first time on this issue. Now, they already issued guidance at the back end of last year, so this is supplementary guidance to give a bit more detail in terms of how you structure the wording and what to put together. That said, if you were expecting that this would give you word for word examples to copy, you're going to be sorely disappointed. What it does instead is it goes through the basic headlines for what you will consider. So how you think about assessing risk of non-compliance with laws and regulations, what work you do to establish that, how you plan work to address those risks and respond to them. And it takes you step by step through each of those headings and really just gives you an aide-memoire list of things to think through. So, for example, when you're establishing how big a deal is this for the client, how heavily regulated is it, you're going to have to think about the sources of potential laws and regulations. Now, for a company, the Companies Act will apply. Presumably they're preparing accounts under UK GAAP, for example, then we've got UK GAAP that will apply as a regulation. We may have other regulations that are significant to them if they're in a highly regulated sector, for example, or there may just be background laws and regulations that apply to every business in the UK. And they're not suggesting that we list them all, but we talk about what process we've gone through to identify which ones are significant, where we think the risks of misstatement might be in the accounts, and principally with laws and regs that the risks are that there's non-compliance, there's a breach, and that could lead to material fines or penalties, or could even threaten the going concern status of the company. And what readers need to know is that we as auditors have thought about those risks and made sure that the accounts properly reflect what's happened. For fraud, where things are naturally more difficult because fraud involves concealment, possibly collusion in trying to hide what's happened, then the stakes are possibly higher for us as auditors. And we need to talk about how we've assessed the risk of fraud and what sorts of procedures we've adopted to address that risk, who we've consulted with, to what degree we've planned unpredictability in the nature, extent and timing of our work, as ISO 240 puts it, to what degree we've done things like using data analytics or maybe increasing a sample that we verify back to source records, how we corroborate by talking to third parties or others. So we're going to have to find some useful, concise narrative to set this out. Now, the FRC expect this to be concise, so they're not inviting people to write pages on what our approach is. And with fraud in particular, I guess there's a natural concern that we don't want to say too much in the report as to how we've tried to address fraud risk, because we want to keep some surprise, some of that unpredictability. We don't want to give the entire game away as to what our fraud plan is to the client who may well be reading our report. So there's going to be an element of reticence. We've got to try and keep it concise. And I think we're all looking for emerging practice among some of the mid-tier firms in particular as to what they're doing on their SME audits. And we're starting to see some of those come through. So by all means, put questions through to us. If you've got questions, you'll need to take some time to formulate your response when you're writing audit reports. And I'd imagine you'll be looking around to see what similar firms are doing. There's a bit of a herd mentality to that, isn't there? If you do ask us questions, all I'd say is don't expect us to give you a nice, neat example that you can simply copy and paste. It won't work like that. This is bespoke, and you'll have to spend some time crafting a suitable narrative to include. So by all means, go and have a look at the Institute guidance. I know a number of lecturers on the circuit were involved in reviewing that guidance before it was published. So I think it's as practical as they can make it. So that's irregularities on the audit report. What else are we covering in this month's Newswire? Well, we've got 3 topics that all revolve around the same sort of thing, and I'm going to deal with them all together here. And it's to do with the FRC and their work. So the first of those is the FRC have announced a modified way that they are conducting their corporate reporting reviews. Now, this is where they look at the corporate reports, including the financial statements that typically larger companies issue. And in the past, they have told us that they've done these reports, but they haven't given us any details on exactly what those reports covered, which companies were involved, and what those reviews uncovered. And in an aim for greater transparency, so we can all understand their work more effectively, they have gone to the process of giving details of exactly what was raised on the review. And it's still brief, it's still in outline, and I think it's done with the consent of those companies involved. But they have explained exactly what they found and where they've recommended, or in some cases ordered, companies to go back and restate their accounts or to address that in a future year with a prior year adjustment and some disclosure. So it's nice to get some detail on what's been a relatively kind of secretive process in the past, and it's good to see what sorts of things emerge. It may be useful for us when we're looking at the sorts of issues that arise on SME audits to get a feel for the sorts of corrections that these companies need to make to their accounts. So that's one thing from the FRC. They've also issued a strategy document explaining where they are heading on the next stage of their journey towards the new regulator ARGA, which will eventually replace them. So they're starting to explain how that will work, how they are transforming themselves already into that new fit-for-purpose regulator. And on the back of that, they've started to talk about their new approach to audit supervision as well, how their 3 separate teams will be looking at audits, audit performance at firms. So if you are in line for FRC inspections, then I think you'll find that particularly of interest. If you are not, if you're covered by the QAD instead, then you might find this of limited interest. But we've got the link in Newswire. By all means, follow that if you'd like to do so. So let's stick with audit for now, and the audit of housing associations in the UK. Now, this is a specialist topic. I appreciate many of you won't audit housing associations, but if you do, then you'll be pleased to note that Practice Note 14, which applies to the audit of housing associations, has just been revised by the FRC. Now, it's not a substantial revision. The FRC have updated the guidance around the devolved regulatory regime for housing associations in different parts of the UK. They've also updated their ISA by ISA guidance. They've looked at some of the risks as they apply to housing associations and done some reordering there. And they provided some supplementary guidance on some of the new ISAs, including ISA 570 on going concern and ISA 720 on other information. One of the most interesting parts about the practice note, though, for me, is the small element of time travel that we can see in it. And that is because although they're issuing this now in April, they're referring to changes in ISA 240 revised May 2021. So I think that's the first time I can recall seeing a standard referred to that hasn't yet been issued as though it has been issued. So there we go. If we wanted to know when the FRC are expected to finally revise ISO 240, they've had an exposure draft out for a while. It looks like it's going to be next month. So see the Housing Association practice note for confirmation of that. Lovely bit of time travel there. Great Scott. Now let's address those of you who are saying to yourself, Jeremy, I don't do audits. Is there anything in accounting and specifically in UK GAAP? I mean, it seems ages since we've had any changes to UK GAAP that are worth talking about. Aren't we due for a triennial review about now? Well, funny you should ask. We are now going to have periodic reviews of UK GAAP. That leaves the possibility open of individual updates to the standard. And of course, we've seen various amendments to the standard over the last few months. But in terms of a kind of thoroughgoing review of the standard to update it, that's going to be done in a periodic manner from now on, not every 3 years. And the FRC has now announced that they are inviting views on how they should update the standard again in the future. Now, we've talked at Mercia with those who are involved in writing IFRS 102 at the FRC, and they do take practitioners' views seriously. And in fact, in the last consultation that led to the triennial review, there were quite a few submissions from smaller firms in particular, and those were read and acted on. So this is important. This is your chance to shape the future of UK GAAP. If you've got niggles about the way the standard works at the moment, if you think there's things it should address that it doesn't, or things that should change, now's the time to have your say at the FRC before they finalise their work and then start to decide what will come in. Now, what might come in? Well, a big question mark is whether some of the big changes to IFRSs will come into UK GAAP. And I guess it's worth just emphasising that they won't necessarily do so. The FRC is not bound to introduce bits from IFRS automatically. And I suspect that they'll be keeping a keen eye on developments in the IFRS for small and medium entities, which is, after all, what IFRS 102 is based on, to get a cue from them. But they're still able to make their own decisions in the UK as to what will come in. So those of you panicking about a new leasing approach for us in the UK, let's just hang fire and see what they actually do. But if you've got strong views on that, again, please have your say right now while the FRC is inviting comments. So let's stick with accounting and let's turn to COVID-19 concessions on leasing and rent. Now, this is an issue that we've talked about before on these Newswire bulletins. We had clearly this change to both IFRS 16 and to IFRS 102 last year for the fact that many landlords felt compelled to give either rent holidays or rent reductions to tenants who were suffering because properties were vacant, possibly in the early days of the pandemic. And of course, that situation has perpetuated to this day, and internationally, this is far from over. So we had initial changes to both standards that effectively, in each case, although the two standards work quite differently in how they approach leasing, in both cases, the effect of the relief was that you would take the relief as it was applicable, essentially, over the periods in which it was intended to compensate you, whether you're using IFRS 102 or IFRS 16. If you're getting reductions in your rent charges in 2020, then you would broadly take those as they fell. And in both cases, that was applied to rent payments that were due before the end of June 2021. Because the situation is still ongoing, what the IASB has decided to do is to extend that measure in IFRS 16 to payments due before June 2022. So they've extended it by 12 months. And the FRC has now announced that they are considering doing the same thing in IFRS 102. They've put an exposure draft to make the same equivalent change. So once more, these aren't the same standard. We have very different basis of accounting on leases in the UK and internationally, but the effect of the relief is similar and the extension would be similar in terms of the date that it applies to. So have a look at that. The link, as ever, is in Newswire, but we fully expect that to go through. Okay, let's talk about IFRS, and let's talk about a new project that the IASB has regarding disclosures and how disclosures are made in sets of accounts. The IASB is concerned that under IFRS, disclosures can often be boilerplate, and that means that the text often isn't particularly relevant. more relevant things could be said and aren't being said because a kind of checkbox approach is taken, that we just go down the list of disclosures and make sure that they're included per the standards, and we're not thinking enough about how to convey the information. So they'd like disclosures to be more principles based, and they have picked two particular accounting standards from the international suite to look at. That's the standard on fair values and the standard on pensions, and they're proposing changes to those disclosures to make them more principles based, to require greater use of judgment in working out exactly what to say and how to present the information. Now, as soon as you start making disclosures less prescriptive and much more judgmental, you open yourself to the charge that the disclosures won't be comparable anymore. That's one thing that they're going to have to grapple with. And it might also make things more difficult for auditors, who then can't simply audit known, clear disclosures, but have to really look at the use of judgment and decide whether that was appropriate. So there's challenges to doing this, but I think most people would agree that having disclosures which are much more meaningful, much less boilerplate, much more relevant to an entity's circumstances would be welcome. So if you are an IFRS preparer, then by all means have a look at that consultation. It's running until October 2021, the comments period, so nothing's going to happen quickly, but it's worthwhile looking at, and there's a video that you can see if you follow the link in Newswire, which just sets this out a bit more clearly from the IASB. So a section for pensions now. The pensions regulator has issued a climate change strategy document, which sets out how it proposes to approach this as a regulator as part of the UK's overall goal of heading towards being zero carbon in 2050. And part of the strategy from the TPR sets out how it expects pension schemes to disclose the responses that they're making to the climate change crisis. Now, pension schemes with more than 100 members already have to comply by issuing a statement of investment principles, and so this strategy document chimes quite nicely in with that. We've also had, for those of you preparing pension scheme accounts, an addendum to the SORP. The PRAG, who write the SORP, have provided new guidance on that statement of investment principles. And so if you're a pension scheme accounts preparer, make sure that you read that addendum. And as ever, a link to that is in Newswire. And that is it for audit and accounting this month. Let's hope the sunshine continues. Let's hope that we all experience a bit more freedom and a bit more chance to catch up with people now that lockdown is easing. We very much hope that we don't have another wave of the pandemic in the UK, and indeed that the international situation improves as well. So please continue to stay safe, look after yourselves. We very much look forward to seeing some of you in venues in the not too distant future, but for now, look after yourselves, enjoy any sunshine that we might get over the next month, and we'll see you at the end of May. Thanks.